We've got Jared Lyons, who's a chief economist at Standard Chartered Bank, who joins us on the show. He joins us on the show. Now, Jared, to begin with, what's the view on Indian government securities? Is it a good opportunity given where yields are at present?
Yes, I think it is a good opportunity, although timing naturally is everything. With the March budget looming, I think in the very near term there's a lot of focus on the overshoot in terms of the budget deficit for this year. The target set in the March budget last year always at that time seemed a bit optimistic, a 4.6% deficit. So I think in the next few weeks there's still a residual amount of concern about where the budget deficit's going to come in for this year, and also about the plans for the forthcoming year. That being said, I think the backdrop though for government securities in India will be positive, largely because inflation is likely to ease in coming months, and that will be the prelude to further easing by the central bank. Inflation at the end of last year was still a bit too stubbornly high, but in coming months I think after we get over the worries about the budget deficit, I think lower inflation, lower interest rates will help the Indian government bond market.
Now, the CRR cut was timely, it was expected. What's your expectation from the rate cycle in India over the next 12 months?
Yeah, I think there will be another 150 basis point cut in terms of rates, so 1.5% off. You're correct, the CRR cut was sort of timely, it was expected. I think a lot does depend naturally on the inflation environment. The RBI, the central bank, has a sort of inflation sort of comfort zone of 6.5% to 7%. The inflation figures we saw back in December were still above that, core inflation at 7.7, I think. So we still need to see inflation easing off to come back towards that comfort zone for the central bank. And once it starts to either move clearly towards that comfort zone or indeed moves to in it, then I think the central bank will feel more comfortable about easing. But I think they will cut rates, they'll cut gradually, but I think they will cut not only because of the easing inflation, but also because of the cooling economy.
Jared, afternoon, you mentioned that we do need to see inflation cooling off before it reaches the comfort zone. So what are your growth and inflation targets for India in 2012, and when do you see a pickup in the investment cycle home? Back here.
Well, the investment cycle is naturally a key thing to focus on. All indicators are that investment plans have been hit very hard recently. Sort of consumption and investment about 90% of Indian economy, the GDP. Consumer spending has been sort of slow, sluggish recently, largely because of the sort of spike in inflation. So as inflation eases, that should in particular help consumer spending. But I think the investment side is far more difficult to call, partly because confidence also plays a key ingredient in that. But there's no doubt that both cyclically and one would say structurally, because of problems in terms of the reform process from the government, investment has been hit very hard and has cooled. I think therefore it's very important for the authorities in India to encourage an environment in which private sector companies feel confident about investing again. Putting us all together, a 7% growth rate for India, or to 7 to 7.5% might be the sensible for the year ahead. But there's every possibility that we're going to see a very weak first quarter of this calendar year, last quarter of the fiscal year for India. 7%, maybe even you could even see growth dipping below that towards 6.5%. So I think India is cooling, it's not collapsing. The weakness of investment plus the cooler picture in terms of consumption is weighing down on the economy. And all of this adds to the likelihood of inflation easing further, the central bank cutting rates, easing policy, and then the economy overall starting to pick up again as we move through this calendar year. So the second half of this calendar year should be a relatively good one for India, but the first 3 to 6 months will be tough, difficult.
And what would be your view on the Indian rupee and the kind of appreciation that we've seen so far? How much more to go, and what are the targets that you're penciling in?
Yeah, well, the recent appreciation has sort of been in line with our expectations here at Standard Chartered. I still think the currency is undervalued, but as is the case with most of these things, a lot of good news gets discounted in a short space of time, just as equally before that a lot of bad news had sort of been discounted in the short space of time. So I think the recent appreciation has been fully justified. It might be difficult to see further immediate headway, but as we see a clearer resolve in terms of the growth picture and the inflation picture, I think the currency still looks attractive on a year-on-year basis. That is, I think later this year it should start to appreciate more. In the very near term, I think the cooling economy and the uncertainty over policy could always slightly weigh on the currency. But I certainly wouldn't be selling it here, and I would be biding my time to buy.
Now, opinion is divided on whether a QE3 will happen or not. What's your own sense in the backdrop of stable economic data coming out of the US?
Okay. Well, at Standard Chartered, we read the US really well relative to the market. And I mention that because last summer the market was very pessimistic about where growth would be in the States. And we thought growth would hang in quite well. And it did. Now the market has moved from one extreme almost to the other because people were maybe too pessimistic and the data has come in better than the market expected. Now the pendulum has swung. There's a lot of optimism about the US. In contrast, we feel that there will be a sort of air pocket, as we call it, US growth. There will be a slight stalling of growth in the next few months in the US, largely because the consumer doesn't really have a backdrop where he or she really feels too confident about spending. The savings ratio is rising, wages are not increasing, jobs growth is still pretty sluggish, the housing market's fragile, the pension situation, despite the rally in the equity market, still overhangs many people's longer term thinking. So there's a whole combination of factors that suggests that if the savings ratio does start to edge up, as it has done just recently, then that will act as a coolant in terms of the overall US economy. That plus the easing in inflation suggests to me that the central bank, the US Fed, will engage in QE3. I think it will be justified, it will be necessary. The markets may not be convinced of it now, but if the data does cool, I think both the Fed and the markets will expect it.
Now, what could a potential QE mean for the dollar, which saw a strong rally last year, and also for US Treasuries, as yields are at an all-time low?
Yeah, but the general feeling is you would think QE3 would be dollar negative. But the reality is that, as we've seen with previous easing, the environment in which the easing occurs in the US is often one in which risk aversion is high, people are nervous. And what we see is that in that environment, people tend to trust the dollar. So in essence, it's hard to call. I would think that risk uncertainty will tend to underpin the dollar despite QE3. But later this year, one would expect if the US economy gets back onto a stronger footing, as I think it will, then it's in that environment you would expect the lagged effect of quantitative easing plus an easing in risk aversion to allow the dollar to then weaken. So difficult to call. In terms of bond yields in the States, yeah, I think they're going to still remain low, consistent with the message that the chairman, Bernanke, gave us the week before last, that US interest rates or policy rates are going to stay low for some considerable time.
So, and you had the EU summit which indicated that Greece might be getting into a situation of a messy default. Does that reduce the amount of risk you're willing to take in the next few months?
Yeah, the leaders in Europe have either been too slow or not comprehensive enough in terms of what they have done. I was in Davos last week. The European policymakers who were there were trying to give a consistent, well indeed they were giving a consistent message, and the message was one that the euro is fine. I think what we've seen recently is that the actions of the European Central Bank have really pulled us back from the brink. The ECB has done a very good job by pumping in liquidity. At the beginning of February, there was the expectation that they would do even more, and I think they will do. Banks no longer feel stigmatized about going to the ECB. So all that is good news, but all it does is buy time. Time's an important commodity nonetheless, but I don't think it eases or resolves the underlying structural problems overhanging Greece. I still think there's a better than evens chance, shall we say, that Greece leaves the euro later this year. Orderly default, I think, is inevitable, but I still think that despite the solid positive actions of the European Central Bank, which have pulled us back from the brink and eased the situation somewhat, despite that, I think the underlying structural problems in the Eurozone remain, and they are most apparent in terms of the difficulty in Greece.
And lastly, what's your outlook on the euro versus the dollar equation, given the pronounced weakness that we are seeing in the euro?
Yeah, well, the euro has actually bizarrely done very well recently, and maybe the euro is going to continue to sort of benefit from the actions of the ECB. But I think that it's difficult to become overly enthusiastic about the euro. Really, the bizarre situation is we need both a weaker dollar for the benefit of the US and we need a weaker euro for the benefit of Europe. But the Chinese indicating that they would be prepared to come in and help the Europeans, provided the Europeans do even more. All these factors, plus the actions of the ECB recently, help to ease the near-term difficulty and maybe help the euro just for the moment. But there's no doubt that the economies on the periphery of Europe still need a weaker euro.